Good morning, everyone, and a warm welcome to the launch of the Financial Accountability and Corporate Transparency Coalition's latest report, A Material Concern, the Investor Case for Country-by-Country Reporting. I'm Ian Gary, Executive Director of the FACT Coalition. For those new to FACT, we are a US-based civil society coalition fighting for fair and transparent tax systems and an end to the US serving as a haven for dirty and illicit funds from around the world. With our colleagues, we've been campaigning for increased tax transparency and so-called public country-by-country reports for many years and have been part of significant victories. These include important new voluntary standards such as the Global Reporting Initiative's tax standard and legislative advances such as the House passage of the Disclosure of Tax Havens and Offshoring Act last summer. Along the way, we've been pleased to have many investors and even some multinational companies on our side in the push for greater financial and tax transparency. Investors are in the business of being in the know, and right now there is a lot to know in global markets and a lot that remains secret. Global governments seeking the resources to tackle existential threats like climate change and the global COVID-19 pandemic are engaging in previously unthinkable multilateral and unilateral efforts to crack down on profit-shifting tax practices by multinational companies seeking to reduce their tax liability. Such practices have robbed the US Treasury and other governments of hundreds of billions of dollars every year. At the same time, political forces all over the world are pushing back on more global and more democratic institutions and governments in a way that is creating geopolitical risk. For example, Russia's invasion of Ukraine and subsequent sanctions and reputational pressure on multinational companies have meant that investors are grappling with the impact on companies they own. Before the invasion, because of a lack of public country-by-country reports, investors had incomplete information on the risk they might face. Due to inadequate Securities and Exchange Commission disclosure rules in the US, investors have very little information regarding the material tax and geopolitical risks they face, making it more difficult to navigate complex investment decisions and to be truly in the know. Public country-by-country reporting can improve securities analysis, providing a more complete picture of material risks relating to free cash flows, corporate governance, and operational practices, as well as geopolitical risks, among other benefits. This is why prudent investors are increasingly calling for this information, whether, as we'll hear today, through shareholder proposals or supporting new mandatory requirements. FACT's new report launched today clearly makes the investor case for public country-by-country reporting. Investors can be better served without any new action from Congress. Today, we are calling on the Securities and Exchange Commission to use its current rulemaking authority to implement public country-by-country reporting for large multinational companies. FACT's report demonstrates the meaningful insights that would be provided by these reports. We have a great lineup to discuss this issue and the findings of the report today, including first remarks from Senator Chris Van Hollen, a champion of tax transparency and the lead Senate sponsor of the Disclosure of Tax Havens and Offshoring Act, which would create a public country-by-country reporting requirement. Katie Hepworth, who is the responsible tax lead at PERC, Pensions and Investment Consultants, Europe's largest independent corporate governance and shareholder advisory firm. Emma Roberts, Vice President of International Relations and Public Policy at BHP, the global mining giant and a leader in tax transparency. And finally, Ryan Garul, FACT's Policy Director and an international tax expert, explaining the findings of our new report. First, we'll turn it over to Senator Van Hollen to present some recorded remarks.
Hi, I'm Chris Van Hollen, and I'm proud to represent Maryland in the United States Senate. And I'm especially pleased to be joining the FACT Coalition for the unveiling of this important report. Today's announcement is all about one word: transparency. It's about the simple but powerful idea that the American public and American investors deserve to know the facts about the efforts of multinational corporations to stash their profits in overseas tax havens in order to avoid taxation here at home. That priority is not new, but it's taken on more urgency following the Trump 2017 tax giveaway, which created new incentives for multinational corporations to ship jobs overseas in order to shield their profits in foreign tax havens, all to avoid their obligations to the American public. That, of course, is bad for the American public. It's also bad for investors with financial stakes in these companies. As the FACT Coalition report outlines, investors face a serious information gap because of these tactics. At a time when the international tax system is undergoing major change, investors don't necessarily know how much a risk a corporation is taking with their money by making aggressive use of foreign tax havens. So this strategy of corporate offshoring and secrecy creates a double problem. It not only sucks revenue out of the United States economy and ships jobs overseas, it also creates real risks for American investors. That's why I'm working with colleagues in the United States Senate to pass my Disclosures of Tax Havens and Offshoring Act, legislation that would shine a light on the games big corporations play to move profits overseas and the magnitude of their dependence on these tax games. This legislation requires big corporations to disclose basic financial information for each country in which they operate. That includes information on profits, on taxes, and on the number of employees in any given country. This information is already collected and privately reported to the IRS, so there is no new record-keeping burden. Among its many advantages, releasing public information on a country-by-country basis will provide investors with the information they need to better understand the tax strategies and risks taken by the companies in which they're buying an ownership share. We need to get this bill passed, but in the meantime, the United States government should be making full use of every tool at our disposal to improve transparency for investors and the American public. I'm pleased to see this report issue a recommendation to the Securities and Exchange Commission to use their existing rulemaking authority to require public country-by-country reporting. And I will continue working with key stakeholders, lawmakers, and members of the Biden administration to get country-by-country reporting on the books and across the finish line, whatever it takes. And that endeavor goes hand in hand with the broader effort to do everything in our power to combat the games that big corporations play to move profits overseas, to conceal information from investors, and avoid supporting public investments here at home. This work is not easy, and it will take all of our combined efforts to make progress. But I'm confident that together we will succeed. It's in that spirit that I want to end where I began, by thanking the entire FACT Coalition for your commitment to this issue, and I look forward to continuing our work together as we move toward greater transparency in our financial and tax systems for the betterment of our country. Thank you, and take care.
Well, thank you so much, Senator Van Hollen, and we really appreciate your strong support for tax transparency and being a champion all these years in that effort. And we'll continue to work with you and your colleagues on the Hill to advance this agenda. We'll now turn to hear various perspectives on public country-by-country reporting, including from investors, companies, as well as civil society. First turn to Katie Hepworth from PERC. Over to you, Katie.
Thanks so much, Ian. And I just wanted to say thanks to the FACT Coalition for inviting me here to launch the great report on the investment case for public country-by-country reporting. PERC has long supported greater tax transparency and responsible tax more broadly. For PERC, tax is both a governance and sustainability issue, and we believe that public country-by-country reporting is the first step in being able to understand a company's tax practices, the aggressiveness of it, and the risks that they may or may not be running, and what this means for investors. So in 2021, PERC decided to step up our engagement on corporate tax transparency by coordinating a shareholder proposal at Amazon that requested that the company prepare a tax transparency report in line with the GRI tax standard. A crucial part of the GRI tax standard for PERC and many of the investors that we've been working with is precisely the publication of country-by-country reporting. We believe that this disaggregation of revenue data, of tax information, and also the number of workers is a really good indication of the way in which a company is moving its money around and the aggressiveness of its behavior, and is a first step in allowing us to engage with companies on how they're optimizing their structures. In starting to file the proposal, we'd identified an increasing gap between tax leaders and laggards, with a steady stream of companies, particularly in Europe, committing to greater tax transparency. And it's good to see BHP, one of those leading companies, on this call today, while other companies continue to resist the calls for greater oversight of their tax practices. Amazon was a prime example of this resistance. Investors had attempted to engage Amazon on their tax practices since 2017 as part of the UNPRI's engagement, and Amazon had failed to engage. At the time that we decided to file the proposal, the company could have chosen to voluntarily follow the precedents set by many other companies globally and commit to the publication of country-by-country reporting. After all, they already provide this information to the tax authorities, and so to our mind, the compliance burden is quite minimal. All we wanted from this proposal was that they make the information public that they already produce and have internally, so that investors could be better informed. Instead, Amazon elected to challenge our shareholder proposal at the SEC. Investors with 3.6 trillion in assets under management wrote to the SEC in support of our proposal, and in a historic decision, the SEC found in favor of investors, which was only the first time in history that it had done so regarding a tax transparency proposal. This represents a huge momentum and I guess a huge shift that we've seen over a number of decades, where tax transparency has become a core issue for investors. The final vote on our proposal reflected this momentum, with 21% of independent shareholders voting in favor of the proposal. The proposal was supported by proxy advisors Glass Lewis and ISS SRI, just to name a few. What it demonstrated when we drilled into who voted in favor was that tax transparency is no longer a niche sustainability issue. It's no longer the domain, as you could have argued, maybe even 5 years ago, of sustainability-focused investors, of religious, of union funds. Tax transparency and responsible taxation, that is, the payment of tax in each of the countries where a company has its operation, is now supported by some of the world's largest asset owners and managers. The SEC's decision, the investor support and company momentum globally for greater tax transparency all reflects changing investor and community expectations regarding responsible corporate tax practices. That is, as I said, that companies fairly contribute to the revenue of the countries in which they operate and earn profit. That is, that they really contribute to the production of the infrastructure and the services that they rely on to make their profits. In light of the historic reforms to the global taxation system at an OECD level, and with national governments increasingly dependent on tax revenue to meet post-COVID deficits, companies who aggressively optimize or avoid their taxes face increased risks of investigations and significant settlements being leveled at them. For investors, companies must at a minimum provide us with the tools to assess the risks of their tax strategies and to understand if and how their tax strategy aligns with their business and sustainability strategy. Public country-by-country reporting is a tool that allows us to assess this alignment. So what's next? We're looking to build on the Amazon vote with 2 shareholder proposals that we recently filed at Cisco and Microsoft. We filed these proposals with investors with 400 billion in assets under management. The filers include Nordea Asset Management, one of Europe's largest asset managers, Academica Pension, the Greater Manchester Pension Fund, one of the UK's largest pension funds, PenSam, and the Missionary Oblates. In the coming months, we're going to be engaging with investors to build the boat at these companies, and we'll also be engaging with other companies to get them to voluntarily publish their country-by-country reporting. Through these proposals, we want to get more companies to voluntarily publish their country-by-country reporting, but our broader hope is that the momentum that we build through these proposals really makes the case for a broader push to have this type of reporting mandated to ensure that there is consistency across all companies and that we're not really seeing these laggards falling behind. Thanks again, and I'm really interested to hear the other speakers today.
Thanks so much, Katie, and we really appreciate you joining and all the efforts you've been making with shareholders to encourage companies to be more transparent about their taxes. With that, we'll turn to corporate perspective from BHP and Emma Roberts. Emma, the floor is yours.
Thanks, Ian, and thanks very much for inviting BHP to speak at this report launch. I'll provide a brief introduction to BHP and our approach to tax transparency shortly. But firstly, like Katie said, really just want to congratulate the FACT Coalition for publishing such a good report. And the report really does make the case for better and more consistent tax disclosures across the US corporate ecosystem, but also globally. So to introduce BHP to people on the call who aren't familiar with us, we are a global resources company headquartered in Australia with a footprint spanning Australia, Latin America, Canada and the US. And our company's changed a lot in the last 12 months through the demerger of our petroleum assets. And so we now have a streamlined portfolio that focuses on iron ore, metallurgical coal, but also on what we call future-facing commodities. So that's copper, nickel, and potash. And BHP's growth strategy is focused on these commodities which are required for the energy transition, namely to enable electrification, battery storage, and agricultural needs. But today, I'm very grateful to be given the opportunity to discuss our approach to tax transparency and really the sort of broader fundamentals that have driven that approach from BHP and why we think, as Ian said in his introduction, why it's more important now than ever that companies are transparent about tax. And this is important for us as well in the context of the energy transition. But at BHP, we are very proud to be a corporate leader in transparency, and we have a long-standing record in that regard. And part of what has driven our leadership over the years and our approach is a recognition that tax transparency is also driven by the desire for us as a company to build trust with a broad variety of stakeholders, whether that's local governments, communities, employees, customers, suppliers. At BHP, by the nature of our business, we've got large on-the-ground footprints in the countries in which we operate and a long-term presence. We operate long-term operating mines. And so we form integral, really quite physical parts of the communities in which we operate. And so for us, the publication of effective and comparable information is key for stakeholders to, as they say, follow the money in terms of the taxes, royalties, but also other payments BHP pays in country, which then the community can benefit from. But disclosure of taxes for BHP has been a journey, and we've learned a lot along that journey with exchanges with various stakeholders, including the FACT Coalition. But we've disclosed our details of our tax and royalty payments for more than 20 years. And during that time, and this is importantly, we've continued to update and expand our disclosures. So our first taxes paid standalone report, which we now call our economic contribution report, and that report covers more than just taxes, it covers royalties and other financial contributions in country. That first report was published in 2016, and since then we've progressively increased the detail of those annual disclosures to meet both global and local tax transparency requirements. But also, really importantly, we've gone above and beyond these requirements through the voluntary disclosure of additional information. And just to give you a sort of understanding of the landscape of our reporting obligations at the moment, or in our disclosures, our current disclosures comply with a number of standards and regulatory requirements, including the relevant UK regulations, which implemented the EU Accounting Directive, the Australian Voluntary Tax Transparency Code, the B Team, Responsible Tax Principles, the Global Reporting Initiative 207, the GRI, which Ian mentioned, and the ICMM performance expectations, which are also aligned to the GRI standards. And we also file additional reports to meet the Canadian Extractive Sector Transparency Measures Act, and we publish our tax strategy, which is required under UK requirements. Beyond that, we voluntarily disclose additional information, including our total direct economic contribution, profit and loss, number of employees and contractors, effective tax rates in the key countries in which we operate for the current year, as well as reconciliation data and comparative data from prior years. And the FACT report really sets out how BHP has tackled this issue. As a mining company thinking more broadly about transparency, we're also a founding corporate supporter of the Voluntary Extractive Industries Transparency Initiative, the EITI, that many people will be familiar with. And EITI requires comprehensive disclosure of taxes and revenues for its supporting companies, but also really has a broad transparency agenda that BHP actively supports, including beneficial ownership transparency. And as I said, we voluntarily complied with the GRI tax standard by publishing our 2020 country-by-country report. And that report is in addition to our economic contribution report, and it will form part of our suite of transparency disclosures going forward. So again, just part of that journey we've been on, we continue to build out our report. We would also suggest that the mineral sector really are leaders, given the number of mandatory and virtually mandatory tax transparency requirements that the sector needs to comply with, many of which I've run through, including the ICMM performance expectations. And this is in addition to the mandatory OECD country-by-country reporting obligations, which are implemented through local rules. So other sectors aren't subject to the same level of rigour in tax transparency disclosures as the minerals sector. And I think that's really allowed the sector to be leaders, but then within that sector, BHP considers itself a leader. BHP's also been a strong advocate for policy on global tax transparency, and very grateful to have worked with the FACT Coalition. And our position is broadly aligned with the FACT report. So we say to be meaningful, information and data should be disclosed, making sure that data is useful to stakeholders and in a format that's accessible, machine readable, and easy to understand and utilise. So we support the establishment of a globally consistent regulatory disclosure framework, including equivalency provisions between jurisdictions, so that investors can understand and stakeholders can compare across jurisdictions. We support alignment between the data provided to taxation authorities on a country-by-country basis and the data to be disclosed pursuant to voluntary standards. And again, the report and Katie just called out the information that goes to the authorities versus what can be viewed publicly by investors. And the alignment of reporting under these initiatives would then create a consistent basis for companies to disclose data. It would minimise compliance costs, so that's a benefit for companies, and really, most importantly, make it easier for stakeholders, including investors, to compare information. And I think just one final point, and happy to pick up on more issues during the Q&A, but as a mining company, as I said, one of the real drivers behind transparency, not only in relation to tax, but other payments, is building trust on the ground with communities. And transparently disclosing our tax contribution really plays a big part of that. So we've found as a company, and I think this applies to other sectors, but certainly for us as a mining company, disclosing information goes a long way in undoing sometimes wrongly held misconceptions or suspicions that communities quite rightly have. So many stakeholders will think companies have something to hide if they're not disclosing something. Maybe, and often they probably do, but we found disclosing even basic information helps dispel that myth, really builds our relationship with our communities, and allows us to have an informed conversation so they can understand the benefits that they're receiving from the resources within that they own as communities. So for us, it's been a journey. It helps us build trust with stakeholders. We absolutely see the benefit for investors. And again, thanks to the Fact Coalition for producing this report. We hope it continues, allows the discussion to continue and action to be taken. Thanks, Ian.
Thank you very much, Emma, and for all the leadership that BHP has shown on this issue. We look forward to the conversation later in this webinar, hearing more about the experiences you've had and lessons that might show for other companies. We'll now turn to hearing about the report itself and to Ryan Garul, FACT's Policy Director. Ryan?
Thanks, Ian. The detailed report can be distilled into three simple truths. First, limited disclosure provided to investors under current SEC financial reporting rules is keeping investors in the dark regarding critical tax and geopolitical risks. Public country-by-country reporting of basic financial and tax data by providing additional information that filers should already have pursuant to international tax reporting standards and good governance practices can give investors needed insights into these risks. The report demonstrates this point by reviewing financial statements and other publicly filed information from, among others, Amazon, whose internal restructurings last year, likely for tax reasons, might have material tax and related cash flow consequences that are difficult to parse under current disclosure rules. Pfizer, whose business was transformed by the COVID-19 pandemic and the revolutionary vaccine it co-created, leaving investors potentially wondering how to value the tax consequences of a business that now reports 75% of its income from foreign sources. And McDonald's and Shell, who voluntarily, due to voluntary filings, have raised questions about how a lack of mandated SEC disclosure could amplify market volatility stemming from risks like the Ukraine and Russia crisis. Critically, the SEC has the authority to implement public country-by-country reporting without any additional action by Congress, as mentioned by the Senator. Second, the information that will be provided by public country-by-country reporting will be material to investors in their financial analysis. Stating the obvious part out loud, because that needs to be done, taxes can materially impact company cash flows. If an analyst is evaluating the value of a company today based on its expected future cash flows, it is woefully inadequate to provide investors with information describing governance reflecting cash flow decisions in a single aggregated international tax line. In contrast, public country-by-country reporting can provide analysts with greater insight into cash flow risks they face, including in light of international tax enforcement and in reform efforts. Similarly, information provided by public country-by-country reporting can provide greater insight into geopolitical risks. Information voluntarily provided by McDonald's regarding its Russian and Ukrainian operations on the day of the invasion is illustrative. Investors might have wanted to price in risk regarding these operations in light of global geopolitical circumstances prior to the invasion, and doing so may have swayed investor stock valuations by as much as $7.20 per fact analysis. Third, the report reviews voluntary public country-by-country filings, international efforts to enact partial country-by-country reporting, and similar sector-based or overly simplified transparency measures, and concludes that while these efforts are with merit, they cannot overcome the information asymmetries in the market today that the SEC should address with a public country-by-country rulemaking. For example, voluntary filers under the Global Reporting Initiative standard, like BHP, are to be commended for their transparency efforts, as are shareholder efforts to advance public country-by-country reporting on a company-by-company basis. But the SEC's goal should be to require disclosure that gives meaningful and ready insight into comparative risks facing investors across markets. Partial standards also face challenges in advancing this goal. Consider that investors are seeking to understand tax risks, and they might be interested in enforcement actions likely to occur anywhere in the multinational's broad gambit of operations, anywhere the multinational books or fails to book profits. Disclosure that focuses solely on reconciling international tax impacts to US tax rates, for example, or that dwells on limited geographic areas like the EU might miss comparative and material risks particular to a given multinational. For these reasons, FACT recommends the following in our report. The SEC should exercise its clear rulemaking authority to require public country by country reporting, ideally starting this process by the end of the year. The SEC should require disaggregated information regarding related party revenues, third-party revenues, profits and losses, tangible assets, headcount, corporate income cash taxes paid, and corporate income tax accrued, among other key items consistent with the information these companies should already be gathering and reporting. The SEC rule should apply to all industries and jurisdictions. Public country by country reporting disclosure should be required pursuant to uniform standards for all applicable filers so that investors have access to data that is comparable and most useful in securities analysis. Required information should be presented with such additional disclosure as filers deem necessary to explain their tax contribution, including versus stated rates, for example. And the SEC should also signal to the Financial Accounting Standard Board, FASB, that FASB should accelerate its US generally accepted accounting principles tax disaggregation guidance project in a manner that supports and complements the SEC's rulemaking. I look forward to discussing these recommendations and the report further, and I want to thank everybody else for joining us as well.
Thank you so much, Ryan, and we look forward to getting into the details of the report. I've shared the link in the chat. I also want to note that the Q&A button is down at the bottom of your screen. For those participants with a question, please do start submitting your questions. But for now, I want to ask some of my own using the moderator's prerogative. Ryan, you mentioned that investors might want greater insight into the potential impact of international tax enforcement and reform efforts. Can you just elaborate on this point a bit?
Happy to, and I'm sure others might have something to say as well. But as we know, right now there is an unprecedented effort to engage in multilateral international reform at the OECD level. But similarly, the US government and other governments around the world are also looking at $150 billion a year in profit shifting losses. In the US, that might be close to 70 billion a year. And they're trying to fight this revenue loss in order to fight more existential challenges, whether related to climate change, COVID-19 pandemic, or other historical inequities, for example. And what we're seeing is real successes for those efforts. For example, in November 2020, a US tax court ruled that Coke would owe the IRS an additional 3.3 billion in underpaid taxes and penalties due to transfer pricing schemes. And Coke could end up owing as much as $12 billion in back taxes if the IRS uses the same logic in analyzing later years of tax payments. Across the Atlantic, McDonald's agreed to pay $1.3 billion in fines and back taxes to French tax authorities in June. And that highlights another thing that I was talking about earlier with respect to partial standards, which maybe we can talk about more later in the panel. But certainly that enforcement risk isn't just coming from the US. As we think about these things, in context also of the global minimum tax deal, which is advancing in many jurisdictions and is made a little bit more complicated by news yesterday on the international tax from the US, but in a way that I think still actually advances the overall narrative. Global governments want US multinationals and global multinationals to pay a minimum corporate tax amount. Looking at aggregate country by country information, which is all the IRS currently is able to publish from those reports that filers already submit pursuant to the OECD rules, 1 in 3 large US multinationals may owe more taxes under the OECD minimum tax deal. And investors right now are kind of just wondering who. There's a lot of fear cast by the shadows of those aggregated information. And that shouldn't be the case. Investors should have much more insight into the serious and nuanced understanding of tax risks that apply, not just for US enforcement or US reform efforts, but globally as well.
Thanks, Ryan. We'll turn to Katie. I wonder if you could expand a bit and provide a little more detail on the differences between how EU and US companies are approaching this tax transparency issue, And also, given the fact that you're moving some shareholder proposals with Amazon and Microsoft and Cisco, why do you think it's so important that the SEC should mandate this reporting rather than, say, companies voluntarily reporting?
Yeah, thanks, Ian. And I think it really is important to kind of look really at what's happening across the ditch for you guys. It's a different place for me, because I think we have seen really widespread adoption of voluntary reporting in the EU. Just to give a couple of examples, the Dutch Responsible Investment Forum has been doing an annual engagement with companies, with listed Dutch companies, about tax transparency. And on last year's reporting, we're still waiting for this year's, we already saw 20% of the largest listed Dutch companies already providing public country by country reporting, with many more making commitments to produce that reporting this year. This is given that the GRI tax standard only came into effect in 2021. So these are companies that even prior to the GRI tax standard coming into force had decided to go ahead and release this reporting. We're also seeing, I guess, in other places around Europe, that similar reporting happening. So a study that was done by PwC into the reporting of German listed companies has similarly found that momentum really building behind public country by country reporting. A lot of this, I think, is a precursor to the mandatory reporting that is coming in at the EU level for public country by country reporting. But it is good to see that companies are already going above and beyond what is going to be required under the EU legislation, because to our mind, that what is going to be required by the EU is insufficient for investors in really gauging the material risks that companies are running through tax and the materiality of their tax practices. Just to kind of give you an idea of that, and the difference between what you're talking about in the report that you've put forward is that the public country by country reporting that we support and that BHP and others are already doing is disaggregated information for every country where the company has operations, not just in the case of the EU legislation for EU countries, plus a limited list of grey area and countries in non-cooperative tax jurisdictions. What we've seen, and I want to pick up on the point that Emma raised around, I guess, the importance of this reporting and what we're seeing in Europe about and companies producing this reporting to build trust. So we saw, I mean, the example of Vodafone, I think, is a core example of this, where they faced, I guess, a huge tax settlement and a loss and real reputational damage around their tax practices. But through the publication of this reporting, they've really managed to turn their reputation from being one of being an aggressive tax avoider to a leader on corporate taxation. And I think it is important to kind of understand really the way in which I think tax avoidance has undermined faith in the tax system and the way it works, and has led to a lot of these reforms, and why it's so important that companies provide this important as reporting as part of rebuilding this information. So as I mentioned, we're putting forward the, and just to kind of say on the US, there are very few companies that we have identified that produce this reporting at this point in time. And we think this is a real issue. We've been engaging with the big tech companies, and an issue that they raise right now is that there is no one else in their sector that is publishing country by country reporting. And we don't think that this is not good enough, mainly because the reputational risks, the accusations, and the impacts of the global tax reforms on these companies is so significant that the information is required now. And we don't think, based on what we've seen in Europe, that there is any penalty from being a first mover on tax transparency. Vodafone, Shell, and others have really said that there is no penalty from being a first mover. For this reason, I guess we want to see mandatory reporting, really just to pick up on the point that Emma said, we want to see this standardization of reporting so that all companies are requested to have the same reporting, and that we actually have the data that we need to make comparisons between companies, rather than really relying on ad hoc information that is produced by companies. There is now a GRI tax standard where we're seeing some standardization of the reporting, but to date, before the implementation of that reporting, really there is huge differences between the different types of reporting that companies are producing, which makes it really difficult for us to kind of understand the relative risks and the relative structures. So for that reason, we would like to see that. And that way we can put our energy into reviewing the data rather than having to put our energy into pushing for the data, which is really where we want to be.
Yeah, that's a hugely important point, and obviously the goal of all of these efforts, to get into the position where you have consistent and comparable data that you can use, both from the investor point of view, but also for policymakers, for civil society groups who are trying to look at whether companies are using aggressive tax avoidance strategies. So that's where we're trying to get to. One question I had for Emma is that, based upon your experience as a large company, what would you say to companies in other sectors to convince them that taking these steps on the tax transparency journey would be in their interest?
Yeah, thanks, Ian. As I said in my remarks, I mean, the extractive sector is somewhat in a privileged position, I guess, because we do have this history of tax disclosure, perhaps more than other sectors, because of the various requirements. So, you know, that's sort of been a little bit of a wind behind our sails, I guess. And because our operations are tangible, they're, you know, arguably more straightforward to tax. But it's really the history of that disclosure that has really pushed us, I think, to take a progressive and incremental approach to disclosure. So as we've allowed it, you know, to sort of, it's really allowed us to calibrate our disclosure with shifting expectations. And as, you know, Katie said, the expectations, the regulations are expanding, they're growing. And so I think we've had the opportunity to expand as expectations have shifted. So that's been an advantage. But, you know, in thinking about other companies that you know, considering, you know, or should be considering being more transparent, there is, you know, there's certainly, I guess, obviously a cost in terms of, you know, setting up the reporting capabilities to publish the data, as well as assurance costs. But really, this is a cost that most companies, you know, will be willing to bear to earn the confidence of the countries in which they operate and of global regulators. And I think the way I would frame it is, you can think of it as a cost, but, you know, that's doing business. We think of it more as an opportunity to really demonstrate what we are giving back to our communities, to the governments, and, you know, to the benefits that we bring to those countries. So if you start to think of it as more of an opportunity to build trust, to be it's a differentiator for us. I mean, that's why we call it our economic contribution report. It's the contribution we're giving back. It allows us to build a closer and more transparent relationship with stakeholders, so government, civil society, communities. It breaks down some of those, you know, those barriers and the suspicion. And so, you know, as extractives company, we need to build those long-term sustainable relationships with our communities. This is, you know, an opportunity to do that. It's a driver, it's an enabler. So think of it, I think, less of a cost or a risk, and think of it more of as an enabler. And that really can assist you with just sort of moving out of the risk and cost frame of mind and into the enabling. And as Katie said quite rightly, this is now a reputational risk. It's a financial investment risk as well. So you know, companies are going to have to move in this direction. Think of it as a positive rather than a risk. Thanks, Eve.
Great, thanks. We have a question from one of our participants in the audience, which is, one of the questions companies ask is, how do investors plan to use this country-by-country reporting information? Have investors started to think about how they will use that information? It would help to persuade companies to adopt public country-by-country reporting if investors would make it clear they know very well what they want and how they will use it. Maybe I'll turn to Katie to take a stab at that question, and Ryan, if you'd want to jump in as well.
Thanks, Ian. Look, I mean, I think one of the main ways is that we want to use it. And I think a core bit that we've been looking at the moment is 3 parts of data, really. And that is, there is the disaggregation of inter-party revenue versus independent third-party revenue, and also the number of workers in each country. And that really gives us, on the one hand, a proxy for the size of the operations. It's not an exact representation, but it gives us an idea of the size of an operations in each country. And on the other hand, it gives us an idea of, the relative size of inter-party revenue, which, we can start to understand around what is the percentage, like how does their revenue really split between stuff that might be related to their operations versus things that are internal shifts of money. At that point, that allows us to really start to ask questions about the alignment of that structure that we can see and how it aligns to the business and sustainability strategy of the company. And that's the point at which we start the engagement and start the conversation. It raises the questions that we want to ask about how they're doing it. If we give the example of Cisco, and I'll let Ryan talk more about this in a second, we don't, and I forgot to mention one of our filings, which was Etica Funds on that resolution, is that we saw a couple of years ago that Cisco had one of the largest repatriations under the Tax Cuts and Jobs Act, which was $77 billion. We know from looking at the kind of headline amounts of money that we've seen a real shift from foreign to local revenue, but we can't see where that might have shifted. We don't know if that also corresponds, we don't think it does, to a corresponding restructuring of their operations. We would have that information if we had, to some extent, country by country information, and we would be able to ask the questions of Cisco around, the basis of their repatriation. So I might leave it there and allow Ryan to kind of talk about the findings from the report with some more information.
Yeah, no, Katie, I think that's exactly right. Just building off what you were saying, I think, what the report finds and what we've heard from investors as well is that, obviously, as I was talking about earlier, there's real cash flow implications relating to tax enforcement as well as tax reform efforts. And trying to understand or get your head around those risks is really difficult with current reported information. But if you have the information necessary to determine what is being moved around just for tax purposes, you start to get a clearer picture of what tax enforcement risks there really might be. And to someone else's question, I think I can maybe answer that as well at the same time. Rio Tinto, they've been engaged with Australian tax authorities for a long time about their tax practices, and this is the result of that. So it's well before their public country by country reporting that these risks would have been revealed with respect to that valuation issue. And that's where I think this is really meaningful for investors. When you start to see that profits are moving around in a way that you start to ask questions, and this is where the GRI standard is so helpful and why we encourage it as part of the SEC's rulemaking with respect to reconciliation, is you do want to know, why are your cash taxes paid so consistently lower than the accrued or the nominal rate in a country, for example? And as we look to maybe a global minimum tax that does not have to be enacted by the US to be effective. It is perfectly effective if it's just enacted by a substantial block of the EU countries or the UK. All of a sudden, you see US multinationals and other multinationals all over the world having to pay 15% in every jurisdiction. And this reveals risk there as well. And I think that is something where investors can really start to discount particular cash flows, for example, and have a different rate of risk with respect to those cash flows in a way that if I were an investor, I would want to have a clearer sense of those risks.
Maybe another question for Ryan. Obviously it's clear that our main recommendation is that the SEC move to create a public country by country reporting requirement through a rulemaking process. Can you clarify why the SEC has this authority?
Yeah, of course. I think that what we found, and I think what other investors have recently pointed out as well, is the SEC does have broad rulemaking authority under sections 12B and 13B of the Securities Exchange Act. And it's important to keep in mind that the SEC's mandate under both the legislative history of the Exchange Act as well as the text itself is very clear that the goal of the SEC is meant to provide disclosure that is in furtherance of public interest as well as for the protection of investors. And this includes accounting information. Pursuant to that, the SEC has issued, really strong accounting rules under Reg SX and has used its independent authority, FASB, or the Financial Accounting Standard Board, to create a strong gap standard to really help understand different accounting risks. But tax is an obvious area of weakness, as are different areas with respect to determining real operations in different jurisdictions. For example, there's been a lot of emphasis recently by the SEC to think about where human capital is, but none of that's on a country-by-country basis, which is kind of an interesting lack of clarity with respect to where and how companies strategically locate their operations. So I think it's clear that the SEC has this authority under their current Exchange Act, and I think that the growing investor momentum, as well as an uptick in enforcement, as well as companies preparing this information already under an OECD agreement confidentially at the IRS for US multinationals or delivering it to other competent tax authorities, I think the timing is also right. There's really a real reason why this is the right time for the SEC to move forward with the authority it already has to make a public country by country rule. And that's not really the question you asked, but it's something I wanted to say anyway. And the only last thing I would note is, and this touches on a point Katie made earlier, but right now there are other standards that are occurring. The EU has kind of a partial standard that's moving forward. Even excitingly in the US, the Financial Accounting Standards Board has kind of mentioned that its tax disaggregation efforts will potentially give more insight in a rate reconciliation method. And these are exciting, but as Katie mentioned, it's just the information is not really adequate in terms of giving symmetrical information for investors for determining risk. And what's interesting when I say that is just because every investor might have a rate reconciliation table to look at for different companies, that rate reconciliation table is going to highlight very different risks depending on how a multinational operates and uses its strategy. And that's what's so attractive about a GRI-like standard, is it actually gives information that allows you to take very different multinational operations and create a more standardized risk profile or understanding of risk, as opposed to if you tie everything back to a US rate, for example, which would really only give you information if you were worried about if the company was supposed to pay US tax. But that's not always true for a US multinational. And certainly under a global OECD deal, there might be a lot of responsibility to pay taxes to other governments, as we've seen with McDonald's in France, for example. And even when you think about the GILTI, for example, a current US minimum tax, it's really hard to reconcile that to a rate reconciliation, especially when you think about the fact that the GILTI works by allowing foreign tax credits in certain high tax jurisdictions to offset revenue in tax havens and profits in tax havens. And you start to wonder, well, which of those two countries is actually causing the US rate to be lower than, or the rate comparatively to the US rate to be lower? And that's a really difficult thing to do on a country by country basis. So while we think those efforts are really exciting, this is why we think the SEC is the right place to move this forward, why we think that the public country by country standard is the right standard to move forward, and why we think that now is the right time to do it.
Great, thanks so much, Ryan. Emma, you mentioned somewhat in passing the link between tax transparency and the energy transition. Could you expand a little bit more on that?
Yeah, sure, of course, Ian. I think the way we sort of think about it is, most people will be aware to support the energy transition, we're going to need a lot more what I was sort of calling these future-facing commodities, such as copper and nickel. And when you look across the globe at the sort of where those commodities are located, they're often in jurisdictions with low or poor governance structures. And so for the extractive sector, but particularly for sort of global, responsible, sustainable miners like BHP, it's very difficult to operate in those countries with poor or low governance structures, because the communities simply don't get the information they need about taxes paid, royalties paid, payments under contracts. And so what we are concerned about is, it will be left to other companies or players to operate in that jurisdiction, and the community simply won't have the information. So by promoting transparency generally and lifting the playing field, or leveling the playing field, so that all companies have to provide this information, as part of a broader transparency agenda, it will then allow the energy transition to be supported by sustainably, responsibly mined commodities, where the most important thing is the communities then get the benefit of the activities in their country, because otherwise, you know, the fear is those commodities will be mined to support the energy transition, but the communities simply won't have the visibility of you know what taxes and payments and royalties are coming as a result of that activity in their communities. So really, it's part of our anti-corruption advocacy agenda that BHP's very heavily involved in beneficial ownership transparency and then tax transparency. It all sort of feeds into that. So we think there is a big connection between transparency and the energy transition, and it's going to be a really important issue.
Great, thanks so much. Well, we're getting to the end of our hour. I wanted to know if Katie or Ryan, you had any last words you'd like to share?
No, that's fine. Yeah.
Okay, great. Well, I'd like to thank our panelists, not least Senator Van Hollen for joining us at the start of this webinar, and for all of his leadership, including championing the Disclosure of Tax Havens and Offshoring Act and his commitment to work with the FACT Coalition on tax transparency with the SEC and in Congress. Really like to thank Emma for bringing in the corporate perspective and the leadership that BHP has shown, and the demonstration effect of having a large and prominent company show that this is possible. And for Katie and all of your efforts with investors, the historic effort with Amazon, and we'll be watching very closely how you progress with Microsoft and Cisco, and we'll certainly be along your side to support those efforts. And for Ryan and all the work that has been done to put together this fantastic report, really appreciate all those efforts. We're very open to feedback on the report. If you have ideas on ways that we can work together to advance transparency among multinational companies, please do get in touch. And as you'll see in the chat, you can sign up to receive more news and events from the FACT Coalition. And we look forward to joining you in future events down the road. Thank you so much.
Thank you, Ian. Thanks, everybody.
Bye.
Thanks, Ian.
Bye. Thanks a lot.
Bye.